Alright, and here we are. Welcome back now to another video of me recording on how to secure yourself financially, especially by looking at the Morningstar investing classroom. I don't know if they have fixed their website because when I clicked some of their course back then, like quite a few weeks ago, they show a pop-up, right, where you can see their content. But now they fix it. Okay, cool, they fix it. Thanks Morningstar. Thanks Morningstar to fix that issue. Let me do this. So when I start here, they click here. Exactly. So they fixed this. Thanks. Thanks. Good. Now, uh, the whole idea right now in this couple minutes is to describe first the several sections that I'm learning here. Okay, and start from the feature content, stocks, bonds, portfolio, ETF, funds, and ESG. If I recall that, which is let me go back here. See it? So feature content, stocks, portfolio, bonds, ETF, funds, and ESG, the environment, global, and governance. Okay, it all starts here by looking at this text-based course, and if you want to get some real-life experience, in my case, I just is betting on crypto, which is a high volatile market. But again, the idea here is to put at practice all of the things that I already learned from staying investing in the market, such as stock has provided the highest return and the increase in the wealth. This is the TLDR, or things to know. Also, investor must have discipline and patience, right? On the long term, holding on can pay off in the long run. And at the end of the recession, small stock, which are small cap capitalization stocks where market capitalizations are between 200 millions and 2 billions. So this is this from what are small cap stock from Investopedia. Okay, market capitalization is about 250 million to 2 billion, right? And the precise figure varies, but it's between that range. 200 billion, 200 million, 250 million to billions. And this small cap stock at the end of a recession, on average, outperform those of the large stock after 1 month, 6 months, a year, and 3 years after the end of a recession. And understand what is interest rate, which is the chart or is the amount of money that you will be charged or in which interest will be earned. And a simple example of that, also understand that similar in the stock market, there is something called the loanable fund markets or the bond markets, right? Where are different interest rates reflecting time length and risk. So looking at these different interest rates, when you look at the bond market, for example, the bond US market, the bond US market from Bloomberg, okay, when you see this on the US, that's right. So there are several interest rates reflecting risk and time length. So this type of interest rate or this short-term interest rates are the treasury bill, 1 year maturity government bonds, and the also the federal rate is another short-term interest rate, and the federal fund rate, which is what we care about here, and they don't show you, but Morningstar tell you that. Well, that uh, this federal fund rate, which is the interest rate at which commercial banks lend fund each other overnight. So the U.S. Federal Reserve, which it was created in 2013, is interesting why the U.S. created that. There was something called the Bank War during the 1850, uh, that well it lead this the system that we're having right now. Okay, and all these monopolistic activities, and that's another whole different story. But right now, the U.S. Federal Reserve, which again it was created in 1913, it has several tools and responsibility. Okay, like the discount rate, which is either the interest rate that the Federal Reserve set to banks for short-term loans. Okay, a short term in this context is a year or less, or is the rate used to the discount future cash flow in the discount cash flow analysis. So this discount future cash flow, okay, is an instrument that allows to measure is the value of an investment based on its future expected cash flow. And when I look at cash flow, which is the movement of money in and out of a company, uh, I also look at the category of the cash flow, right? And this category, it comes from the financing, operational, or investment. Because I just want to dive deep in the rabbit hole. Where did this come from? So where does this uh, data come from? Where does all this concept come from? Which it comes from the SEC, from the beginner guide, reading the beginner guide to read financial statement. Something that I'm going to talk later, but right now I'm just focusing. I'm gonna focus is on the Federal Reserve. So going and backtracking, okay, in the conversation to the point here with the Federal Reserve that since the Federal Reserve, right, set the discount rate, the uh, the prime rate, which is it tells the banks how much they charge to their most credit worth client, usually corporations and companies. Also, it oversees the national banking system. It creates policy, monetary policy, also prints money, and uh, try to achieve the federal fund rate by buying and selling security in the federal open market. Okay, and a great example here is for something that I've been used here a couple months, weeks. That imagine that you have is benevolent father and mother where you ask for money and you have brothers and sisters, younger brothers and sisters. When you ask for them for a loan to buy a cappuccino, right? Uh, they give you the money with 5% of that. So you have to pay them 105% of that. All right, but you think you're smart enough you, okay? And you're going to lend this money to your younger brothers, and you're gonna sell them a dream, right? That they're gonna buy anything that they want. Your younger brothers are like 4 or 5 years old, and you tell them that you're gonna find their success and dreams by buying candies, right? Only uh, that they need to get that you uh, that from them you only need is to get a 7% back from the money that you lend. All right. So meaning that you're going to earn much more money and repay the debt. So what you're doing is by selling a dream to your younger brother, okay, as long as he is efficient and productive, right, he will able to pay that. Otherwise, you will have a massive debt in your hands, all right. That's an analogy I would like to use, especially when you think you are 13 years and you thought that you master anything, any faculty in your life. In any case, so looking here, back here to this, and understand that, like the stock market, the bond market, or this loanable fund market is also affected by the state of the economy. So the interest rate on bonds are affected by the demand of loanable funds. And during an economic contraction, the demand for loanable funds fall as the interest rate to stimulate consumer spending. And during an economic expansion, the demand for loans uh, tends to increase, making the interest rates higher than before, right? Which is increasing the the cost of borrowing. And with those two concepts, the contraction and expansion, that is the next topic here, okay, from the market terms and recoveries. So, again, looking at the historical data, especially for investors who have long term goals such as retirement, see how the market performed is something important, and also see and also you are able to see how risk decline over time. Cool, cool. All right. So looking at this stock market contraction and expansion over the past 49 years, starting from 1973 to 2001, that there have been 10 market contraction, which the graph are shaded in yellow. So a contraction is defined, uh, before explaining that, is that the contraction phase of a stock market, the region shaded in yellow here, the regions shaded in yellow highlight a contraction phase of a stock market price, of a stock market cycle, meaning a complete round of a stock price fluctuation. Okay, so that is what this mark, the yellow regions indicate, right? A contraction in the stock market cycle, meaning, well, the stock markets uh, decline, or the stock market cycle, meaning is the end of a stock market price fluctuation of a stock, yeah, the end of a or a complete round in a stock market, a complete round in a stock of a stock price, yeah, of a stock price. is this a complete round of a stock price fluctuation, and these cycles vary in length and duration. So the green region shows the expansion. So a contraction is defined when the stock value, stock when the stock market, uh, when the stock market value decline from this peak, when the stock market value from its peak by 10% or more, right? And this decline seems to happen at random times and lasts for varying time periods. And the expansion measures the recovery of an index from the very bottom of the contraction from its previous peak and the subsequent performance before another level peak, or until it reach a next level peak level before another 10% decline or more, right? So this is the technicism here. Okay, talking about is the contraction and the expansion, and the question is, okay, as an investor, how all of these are applicable, to make better, well-informed decision, or to make well-informed decision. This is important to understand and to know, because the things to know here in looking at this contraction and expansion is that investors must have a long-term horizon to allow their investment to grow. Meaning is, let's say you believe in Ethereum, right? So you invest on that particular asset, meaning that you invest on a particular house, okay, for the long term horizon. But also you have to understand and make your market research before doing that, at least to give you a sense of uh, where this market goes, especially in yourself. Like where is this market going? You know, where is this market truly going? You know what I mean? And then I look at the market downturns and recovery. This is perhaps the most confrontational, groundbreaking, mind blowing data that I saw, because I am living right now a recession. Okay? So, by looking at this historical downturns and recovery, again, to see how the market performed, the US equity market has passed through different bear markets, and the most severe it was in the at the beginning of the Great Depression in 1929, where the stock lost over 80% of the value, specifically 83.4% according to Morningstar, and the recovery period took 12 years, my friend. 12 years. More recent, at the early of the 2000, during the dot-com bubble, right, the stock lost 44.7% of the value, and the recovery period took over 4 years. It was the second longest time in recovery. Yeah, it was the second longest in history. 4 years. Okay, so what are you gonna fucking do in 4 years or 3 years, which is at the beginning of the uh, 2008, 2007, 2008, during the banking and debt crisis, where the stock lost 50.9%, okay, during that recession, and the stock market recovered after 37 months in March 2010. Again, we're talking about recoveries, and the recovery, if you remember what is a recovery, is the upswing in price security following a long decline, according to Morningstar. The term is also used to describe is the nation's activity economy, or the upswing nation's activity economy. So the things to know of this is, even though betting in the market or investing in the market, stocks are prone to sudden loss in value for different reasons: war, pandemic, social conflicts, you name it, right? You name it. And again, investors should have patience. Okay, and the recovery period may be painfully long. Often, the decline is preceded by a period of high return, which lure investors into a false sense of security. Which lures investors into a false sense of security. Because no one can predict market declines with certainty, a diversified portfolio may be the best solution for a long-term investment. Exactly, something that we already know when we talk about uh, that investor must have discipline and patience. The way to do that, according to Morningstar, is using uh, two couple things for dealing market downturns, like maintain a well-diversified portfolio and DCA, dollar cost averaging. Again, maintain a well-diversified portfolio doesn't eliminate risk. The idea here is to minimize that. And with the dollar cost averaging, it doesn't ensure you profits or protect you from financial losses, especially during market downturn. Okay, so even though consider that, great. Now, uh, then uh, I look, which is currently what I'm doing right now. Currently, what I'm doing right now is this: looking now the asset classes and downturn. So now I saw is the market contraction and expansion in downturns and recovery. Generally speaking, now I'm going to look respect with some asset class, such as bonds, stocks, some other asset class, with some sample portfolio examples. We also look at the correlation of different assets with the broader market. Okay. So once I look at the bond yields that are driven by factors such as the supply and demand for loanable funds, the monetary policy, and the inflation expectations. So the Fed has two primary tools to set the monetary policy. They have is the federal fund, the discount rate, okay, and the uh, the discount rate and the federal fund rates, okay. And during a recession, the demand for loans fall. The Feds lower the interest rates to make the cost of borrowing lower and stimulate consumer spending. And during an expansion, the Fed wants to keep inflation in check by tightening the monetary. The Fed may want to keep, may want, according to Morningstar, right? But most likely they want. You know. So during an expansion, the Fed may want to keep inflation in check and tighten the monetary policy by increasing interest rates. So short-term interest rates, like treasury bills or federal fund rates, have a close correlation with the federal fund rates, okay, which the Fed target through uh, open market operations. Okay, so short-term rate has been more or have been volatile, whereas long-term rates, which have a maturity of 20 to 30 years, have been relatively stable and have taken longer to react to change in the economy. Okay, makes sense, right? So because I dive deep so I'm getting to the rabbit hole of what is the discount rate, especially to understand that, right? Discount, discount rate here, right? Where the discount rate, something that I mentioned before, is either the interest rate that the Federal Reserve charge to banks for short-term loans, or the rate used to discount future cash flow. This valuation method, okay, the discount, what the, no, discount cash flow, this valuation method to know the value of an investment based on its expected future cash flow. Okay, so the DCF analysis attempts to figuring out the value of an investment based on projections how much money it will generate. It focuses how much money it will generate. It is funny because it's not focusing on how productive it is. It focuses on how much money it will generate. And it is funny because if you look at the discount cash flow, okay, uh, take a closer look at the discount cash flow here, right? So the discount cash flow measure is the projection of an investment today based on how much money it will generate in the future. Okay, but you are you're not measuring its productivity. You know what? And measure productivity is very hard. Actually, it's very hard, and it's very independent of that particular company and things like that. So the measuring is based on money, which it doesn't correlate at all. But okay, welcome to the game. But okay, welcome to the game. Here the just focuses on how much money this company may generate, blah 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 blah. But this actually doesn't make sense in the real world because to actually know the value of something is that how much that thing is productive, or in the case of people, how much skill that person is in different scenarios. All right. For example, for comments, the social skills, comedy, how they feel, how they manage stress, you know. But it's okay. They use that, whatever, whatever, whatever. Now, uh, once I look this, okay, evaluation method used to estimate the value of an investment. Yeah, this evaluation methods to know what the value of this investment will be based on the suspected future cash flow on this moving of money in, money in and out of the company. Okay, so when I look at the cash flow, uh, especially to understand this, which is the net amount of cash equivalent and cash being transferred in and out of the company. So, in other words, the cash flow is the movement in and out of a company. You know, it's the vital block. And the company cash flow is typically all categorized from operations, financing, and investing. So when I dive deep here, the beginner dive of financial statement here, which is to me is very interesting how they create a story to then teach you is how to read this financial statement, okay, and how to make sense of that. So they tell you, well, if you can read nutritional labels or baseball or soccer box score, you can understand or you can learn how to read basic financial statement. And if you can follow a recipe or apply for a loan, you can mm, learn basic accounting. And the basic are difficult and they're rocket science. So this section is designed to help me or anyone, okay, to gain you basic understanding on how to read financial statements. Just like a CPA class won't teach you, or just like a CPA class teach you how to perform cardiopulmonary resurrection or resuscitation, correct? Okay. So how using a CPR class teach you how to perform the basics of cardiopulmonary resuscitation. This action will teach you how to read the basic part of a financial statement. It will not train you to be an accountant, just like CPR class won't make you a cardiac doctor. But it should give you the confidence when you it should give you the confidence to be able to work and set up a financial statement and make sense of that. And this introduction or the basics to me it was like interesting. The reason why I'm replicating here this is if I want to tell to someone else, right, about, or if I have to sell the idea, because what you're doing here is try to sell the idea, right? If you're going to try to sell the idea, actually they're doing that. Pretty basic. So they're selling me this idea, okay? By finding, in the case of selling or selling a solution, selling process, is that diagnose the needs or the opportunity that a prospect will have or already have and offer the product or service to solve the challenge they have. And that's basically what they do. They're now showing me is the opportunity here, all right? The opportunity of learning the basics financial state. Okay. By, well, indicating how from real life examples you can make sense of them and uh, uh, include is what are the things that you're going to learn here, which is uh, learning how to read or how to gain, yeah, learning how to gain basic understanding in read financial statements, especially on English, because I'm quite familiar with that on Spanish, okay, but is that help me to gain an understanding uh, in how to read financial statement Uh, just like a CPR class teach you how to perform cardiopulmonary resuscitation, which is something that I don't know how to do that specifically. Generally, I don't know. I have some scattered stuff from some movie, but generally, I don't know how to perform that. If I in that position, well, I will ask for someone that can do that, or well, I will be me performing that with my scatter knowledge. But in any case, uh, so yeah, so uh, it will not train you Okay, it will not train you to be an accountant. Learning the basic part of financial statement and understand them, just like a CPR class will teach you how to be a cardiac doctor, but it will give you the confidence to be able to look at this set of statement and make sense of it. So, what is this financial statement? And they mentioned that we'll remember for Cuba Gooding Jr. in Modern Life from the movie Jerry Maguire. I barely saw that. I just saw a trailer, and when I did that, it was like uh, so. YouTube put me not on a strike, but put me a warning. It was like, hey, you shouldn't do that. But in any case, all right. Okay, so we all remember from Cuba Gooding Jr. Immortal Lines from the movie Jerry Maguire. Show me the money. So, well, that's financial statement, right? So, from this movie, Jerry Maguire, so Cuba Gooding Jr.'s Immortal Lines, it's like, show me the money. Well, that's what financial statement do. So, they show you the money. They show you where company money came from, where it went, and what is it now. That's the three state of the money where it described. Okay, so that's basically a financial statement. They show you the money, much like in the Jerry Maguire movie, from the Immortal Lines, or from Cuba Gooding Jr. Immortal Lines. Uh, what they teach you is uh, when they showed off that show me the money, so that's financial statement. So they show you the money, they show you where the company money came from, where it went, and where is it now. So there are four main financial statements, and there are four main financial statements, right here. Uh, we have balance sheets, income statements, cash flow statements, and statements of shareholder equity. And you're going to make here a quick pause. Exactly. Okay. All right. So here we are. Uh, hmm. So there are four main financial statements. There are balance sheets, okay, income statements, cash flow, and statement of shareholder equity. So in Spanish is uh, hoja de balances, declaración de, declaración de ingresos, declaración de flujo de caja y declaración de las acciones o del patrimonio de los accionistas. Okay. O el patrimonio, just like that. Okay. So there are main four financial statements, like balance sheets, okay, balance sheets, income statement, cash flow, and I will draw some image here, right? some mental image, right? So you have balance sheets, okay? Balance sheets, income statements, cash flow, and statements of shareholders' equity. So balance sheets show what a company owns and what it owns at a fixed point in time. So a balance sheet show what a company owns and what it owns at a fixed point in time. Okay. So here's this. So okay. So a balance sheet show what a company owns and what it owns at a fixed point in time. For example, for example, what a company owns assets, much like our assets. I'm going to make a quick real example here from McDonald's, right? So a balance sheet show what a company owns. Okay, let me do some research here from McDonald's. McDonald's balance sheet sheet, right? And McDonald Corporation balance sheet. Oh my god, this shit is public. What the hell? What the hell? This thing is public. What? Huh? Is this for real? All over in thousands. Is this for real? What? Holy fudge. The hell? We live a fucking recession, man. Earnings and revenue. I get it, man. Jesus. I get it why a lot of people, it's because the entire model promotes the money. Not the productivity, not any of those things. It's the money, man. So they're promoting is their own system. It's not bad. It's not bad. It's not bad. It's the way how the US wants to take control of the entire world or the universe. Uh, the hints. It's like what? Okay. Cash equivalent, receivables, inventory, prepare assets. Again, you know what is funny? It's like okay, this may be public, but who tell you or who told you that this is 100% sure that this is not make up data? Oh my god! But it's important, or the thing that's struck me the most is like, man, and also you have the income statement, the cash flow. What? What? Okay, interesting, interesting, very very interesting. Yeah, dude. So Apple balance sheet. What the balance sheets from Google? I mean from Yahoo. There you got it. Apple income statement and balance sheets. What the fuck? Fuck me. Apple Inc. APL. People also watch Tesla, Amazon. in Google, Meta, Netflix. Mm, no, what about 6 months ago? After the layoff, holy, you gotta be fucking me. After the massive layoff, oh my god. After the massive layoff, they say, you know what? Yeah, I think you're doing things great. Oh my god, the market talks. Oh my god, the market talks. Wow. And this, oh my god, I get it. I, 4, 4, 6. I'm watching The Matrix, man. Uh, I'm watching Jesus from. It's like after that recession, right? 6 months, a year, like this, a year, right? So where the stocks are like this, there of course a market correction because those people were not efficient as they mentioned, right? So they're not outputting most of the things that they're supposed to, right? And because of that, well, they say, you know what? Uh, I'm going to lay off a lot of people here. And that's exactly what they started to do. Massive layoff, massive layoff, massive layoff. And of course, now people, Jesus, now people trust in this company, all right, because they are self-corrected in a way that now they show that the people that they are with them are real professionals. It's like a sniper, like a mercenary, like deadly. It's the dead squad. It's like Bope, this battalion, the Bope. It's like the battalion of batalhão de operação policiais especiais, BOP, or BOP, batalhão de operação, batalhão de operações especiais. Exactly, It's like holy fuck. Okay, this is interesting. Oh, okay. Ooh, oh, my mind is expanding. What, bro? The hell is this? My mind's expanding, man. It's like, what the? Okay, this is something interesting because now I'm looking is real time is the concept that I'm learning. You know, it's not theory; it's also practice. Okay. So go back here. This balance sheets. Okay, that the balance sheet, and it all start with a question. It's like, hey, uh, what is balance sheet? Can I look balance sheet from McDonald's, Apple? Yeah, you can. And also income statements and cash flow, but not the statement or shareholder equity. You know? Okay, okay. So balance sheets show what a company owns and what it owns at a fixed point in time. So what a company owns, in the case of McDonald's, what a company owns, total asset, total liabilities, total debt minority, total equity grows, stockholder equity, total asset, current assets. Okay, so these balance sheets show you what a company owns and what it owns a certain period of time, or what it owns at a fixed point in time. So it have cash equivalent, and receivables, accounts receivables. inventory. Okay, they have reduced their inventory. No, in fact, they have increased their inventory in money. Prepaid assets, other current assets. So taking now in my own case, all right. So what are the things that I own and what I own at a fixed period of time? For example, my laptop. For example, the keyboard, the mouse, uh, the cell phone. Allegedly, I own that. Not the software or not anything that runs inside of this, but this device, right? And it is important is to make that list of things that you own. Okay, all right. Okay, okay. So, so with that, I'm going to wrap up this video until the next episode. So, take care. Bye bye.